Good morning. My name is Lee Corey, and I'm the managing partner of Smart Business. On behalf of the Smart Business team and all of our sponsors, I'd like to welcome you to the 2021 Columbus Smart Business Dealmakers Conference presented by Ice Miller. We have a star-studded lineup of roughly 50 speakers today, including timely interviews with business leaders and dealmakers throughout the region that will be streaming throughout the platform this day. Part of our goal is to empower you to connect the dots. At today's event, you can join general and topical networking sessions, offer questions to our panelists during live Q&A sessions, join small group video meetings, and even schedule one-to-one Zoom calls with other attendees. Today's event is brought to you in partnership with 20 leading organizations, and I'd like to extend a special thank you to Kathy Strauss and the team at Ice Miller, our presenting sponsor. To help us plan this year's Dealmakers Conference, we formed a host committee of leading entrepreneurs, investors, and advisors from around the region. I'd like to thank each one of them, as what you see today is a culmination of their efforts. Now, I'd like to turn it over to our presenting sponsor, Kathy Strauss, Columbus Office Managing Partner, Ice Miller. Thank you, Kathy.
Welcome to the 2021 Columbus Dealmakers Conference. On behalf of Ice Miller, we are elated to once again bring you this M&A event, which highlights deal-making in the region. Ice Miller is a full-service law firm with nearly 400 lawyers in 6 states. We have a particular focus and niche in both working with buyers and sellers of businesses and providing full-service legal services to the surviving businesses. Our Columbus deal lawyers are well known, bring years of experience and a multitude of skill sets to the table. I encourage you to talk to our deal teams of Rob Willett, Ed Brom, Tom Pampush, Chris Michael, and Joe Keglovich, to name just a few. We have a great day in store for you, with different types of sessions throughout the day and more than 50 different speakers, including our midday keynote, panel conversation on people and the impact post-acquisition. We think you're really going to enjoy all these conversations and panels, and we've created numerous opportunities to network with one another. We hope you explore all the great features of this year's conference. And while we can't be with you in person this year for the full conference, we have been able to pivot to this virtual environment. We hope you enjoy it, and we look forward to seeing you all again next year in person. Now, to tell you about our amazing kickoff session for today's conference, please welcome my partner, Tom Pampush. Tom?
Thank you, Kathy. We at Ice Miller are delighted to present the kickoff session today with a great group of panelists. First, meet Kumi Walker, Chief of Corporate Development and Strategy from Root Insurance. Next, please welcome Matt Bennett, Partner, Talisman Capital Partners. And finally, meet Paige McCarthy, Senior Analyst, Tri-W Group. Moderating the session is one of my partners, Chris Michael, here at Ice Miller. Chris, take it away.
Good morning, everybody. It's good to see everyone. Let's go ahead and get started here. I appreciate all of our panelists here for jumping in and providing their new and emerging perspectives in M&A. So again, thank you, everyone. My name is Chris Michael. I'm the moderator for this panel. I'm a partner at Ice Miller in our business group. I spend most of my time counseling and representing financial and strategic buyers and sellers in the lower middle market across a variety of industries. But enough about me. I know we've had some introductions, for our esteemed panelists here. There's already been some introductions, as you know. So what I'm going to do is I'm going to turn it over to each of you and give you the opportunity to introduce yourself, as well as your company, and then we'll get things started. So without further ado, Kumi, would you like to get started?
Thank you for having me. My name's Kumi Walker. I lead business development and strategy at Root. Root is an insurance technology company based and founded here in Columbus, Ohio. The company was started in 2015, and we went public last year in 2020. Prior to joining Root, I led platform business development for Twitter, and then was a general manager of the premium live video business there. I joined Root in July of 2018. That's what brought me to Columbus. And I serve on the board of CODA, Central Ohio Transit Authority, as well as Olive, a healthcare technology company, and MI Homes, a home builder, national home builder based here in Columbus.
Excellent. Thank you. Matt, let's go to you next.
So my name is Matt Bennett. I'm with Talisman Capital, and Talisman's essentially the private investment company of the Walter family. And so I spend my time on private investments. Prior to Talisman, I was with a group called MedVet that does ER and specialty veterinary hospitals, where I led corporate development efforts for them. And then prior to that was out in New York City with JP Morgan. And I did investment banking in the sponsor group there, as well as corporate strategy and the digital payment side. So thanks for having me.
Excellent. Thank you. And Paige?
Thanks for having me on the panel. My name is Paige McCarthy. I'm a senior analyst at TriW Group. We are a family office here in town. We focus kind of on a two-pronged investment strategy. We do investments into real estate as well as operating companies. Personally, I specialize on the operating company side of things, underwriting deals and seeing them through the due diligence process, as well as helping integrate them and work with them on operations post-close. Prior to joining TriW Group, I was with L Brands and corporate finance for about 3 years. And that is what originally brought me to Columbus.
Excellent. Well, welcome everybody. And again, thank you all for being a part of this panel. This is quite a great panel, for what we're looking to do here. Again, the title of our panel is New and Emerging Perspectives in M&A. And so, while we're all Columbus-based folks here, our reach is a little bit different. And, we all go beyond the Midwest here, I think. And so, this will focus on some local flavor as well as some non-local flavor. But, with that said, we jump right into it. I think we'll all agree right now that, where we're at in September of 2021, from an M&A perspective, transactions have never been higher. We've never had this high of a deal flow. And the only thing I can analogize it to, frankly, is I think Q3 and Q4 of 2012, when we had a lot of Bush tax cuts that were set to expire, and there was a lot of frenetic pace to try and get transactions closed. Now I think it's a little bit different, and I think that's where a lot. I think a lot of this panel will center around today. But nonetheless, I think it's just so much different. The last two and a half years, we've gone from seeing a lot of sellers, right, being in a seller's market, was very seller friendly, to now I'd say that it's even more seller friendly in some respects, but there's a lot of wonkiness and weirdness out there. So I guess to get things started, and Matt, maybe we start with you here, from your perspective, in this really hot deal marketing that we're in now, I mean, there's a lot of challenges, coming out of the COVID scenario or wherever we're at in that. We've got a lot of new challenges that have been presented to us in the deal space. What are some key issues, that you are seeing right now that have really changed over the last two and a half years as we move forward?
Yeah, I think, one interesting trend has been on the growth equity side of things. So, kind of primarily with the Tiger Globals and the SoftBanks of the world, but, it's this emergence of kind of high velocity capital deployment, which has created a pretty unique environment. It's a really interesting dynamic, particularly for growth-oriented private businesses looking for capital, where it's almost less about the value-add capital and more about access and speed and limiting disruption to the business. And so the core really kind of revolves around the amount and velocity of capital that some of these new groups, or I guess they've always been around, but they're kind of playing a different game now. And I guess maybe a few anecdotes. I think they're closing a deal every 2 days is what I've heard, which is pretty incredible. And then they're also closing deals basically within 24 hours of getting financials, and a lot of times coming in, 15 to 25% above, the ask. And so it's this like really different game that's being played on the growth equity side of things, where it's much more focused on velocity than deep due diligence or haggling over price. And so it's been interesting to see it evolve where we've got partner companies that are seeking growth capital at various stages. And these folks are kind of coming in, writing multi-$100 million checks, closing within X number of days. And it's hard if you're competing against that, but it's really great. It really resonates with a lot of the companies out there where, hey, a fundraising cycle can be, unbelievably disruptive, time consuming. And these groups are coming in with more velocity. And as an asset manager, I think it's worked out quite well for them. But really, it's only emerged over the last X number of years. And I think COVID's accelerated it. But it's been an interesting kind of nuance to at least navigate around in that end of the market, but maybe different across other pockets.
I just on that, I think there's that while that capital has been around, the dynamic you spoke about of this very little due diligence, deploying writing $100 million checks is quite different and new. And the other piece and element and the competition around this is this capital is getting deployed whether you as the entrepreneur take it or not. And I know that there are tactics that investors are using where that is the kind of stick to get into a round is, take this money or we'll fund your competitor. And this is a pretty unusual time because typically those size checks really go toward businesses that have been around for years, that are really predictable, that have 5 years of financials that they can go and send as part of the due diligence process. And the unusual part that I think that's happening right now is you're seeing those checks go to companies that are, Series B, might not have more than 2 or 3 years of financials. And, to the point made earlier, really only happening of just days after even connecting with the entrepreneur in real life. So it's just a pretty unusual time for that amount of capital being deployed.
Yeah, that's a really good point. I want to come back to that too. Like when we start talking about, post closing, so maybe we revisit this, but that's a really good point and a good illustration here of kind of some of the weird vagaries that we're seeing here. We'll definitely want to come back and touch on this, especially when we talk about like the truncated due diligence process. I guess one thing to follow on, Kumi, right there. I mean, it sounds to me like you're seeing a lot of, this high velocity capital deployment. We've gone from more mature kind of, companies in the middle market, right? Now it's kind of moving up, to a little less mature. Would you say it's still in the VC range? It sounds like it based on the Series B comment, but you have any thoughts on that?
Yes, I mean, it's definitely not limited to the public markets. It's also not limited to, you would see this scale of investing happening in the private equity markets. But the Tiger really has changed what this looked like. It was SoftBank, let's call it 5-10 years ago. They were the only company really writing those types of checks. I think Tiger has a model and does a bit more due diligence than a SoftBank. But once they've decided on a company, they move a lot faster than I think what traditional, even VCs were used to in terms of the vetting of a company, an entrepreneur, or a team. And I think that whether that maybe it's happening before, and there's a lot of due diligence happening before that initial meeting, but the time from initial meeting to close of investment has changed meaningfully in the last 18 months.
And Chris, on the private equity side, we have a veterinary business in market right now, and a lot of the mega fund PE groups, more upstream, a lot of them are coming in, and I think they're heavily influenced by, the alternatives, like the Tiger Globals of the world. And so, they are getting quicker. I think they're underwriting the industry and the general model, and then, they're kind of confirmatory stuff on the specific business. And so it allows them to move quicker. But it is amazing to see the competitive dynamics from a capital standpoint where, it used to be, hey, look at all of our operating partners and look at all of the bells and whistles and, going off of brand name. But it is very much of a, hey, how quick can you close? How flexible can you be in terms of structure? And, all of the other stuff feels like table stakes, which, is pretty unique. And a lot of the entrepreneurs, well, they want the value add, and great operators want, the value add components. I'd argue there are, a lot of groups that say, hey, we don't need a bunch of advisory help. We don't need somebody kind of meddling in a lot of the decision making. And so, it's almost like, hey, how can you be least disruptive and quick? And that's been winning a lot of times. So it's been interesting.
Yeah, this is really good. Before we depart from this, I mean, it seems as if, there's, from a legal perspective, a truncated front run due diligence, process seems just anathema, right? Traditionally speaking. And so to kind of have that front run, you look at, well, what are our post-closing liabilities going to look like? And you're kind of washing it under it's kind of water under the bridge until post-closing. Do you think that, from my perspective, I feel like the advent, or called the evolution, of rep and warranty insurance has really made this also possible. Have you guys seen, any of these, high velocity, deals in which don't have an RWI policy attached to it?
I have, yeah. It's been interesting to see. It's gotten more and more popular, and now all of a sudden, when you're looking at, hey, no post-closing liabilities, it creates a pretty interesting dynamic.
Yeah, it feels a bit like the housing market in San Francisco, where I moved from. In that, you didn't get your deposit back. You came ready to every open house to buy the house and sign with no contingencies. Like, that's what some of the investment market feels like right now.
It's kind of evolving like that in real estate here in Columbus too, I suppose. Well, this is great. Well, I want to come back to this on a few topics, but staying along this whole, differences in the current market, Paige, what are some perspectives that, if you want to dovetail on this, or if you want to, go in a different route, what are some perspectives that you've seen?
Yeah, from our space, looking at kind of some lower middle market deals, we are still typically looking at more mature companies. But even amongst that, people are really competitive now, and it's more work for us to tell our story and say, if you want no exit price and long-term patient capital with pairing with an operating partner, we've got to really tell our story well and talk to our differentiators to go up against some of these people who are willing to write really, really quick and very large checks. For us, this kind of comes through in the due diligence process. I mean, when we're screening deals, there are things that we have to get comfortable with more quickly than we once would have in order to be competitive. One thing I can speak to that's across the board, I mean, people are getting so much pressure from material price increases. This is something that a lot of companies have had, an issue being reactive to and passing that through quick enough so their earnings and their profitability are being hit. We're seeing a lot of adjustments to earnings coming through on potential deals. And we've got to really make sure we can get comfortable with that quickly and get on board in order to maintain our competitiveness in the bidding process.
Yeah, that's I hear that. Is there any, on those material price increases, have you had some supply chain issues that might have been arising? It seems to be a common theme that had been talked about in the last 12 to 18 months.
Absolutely. Supply chain issues are very consistent as well. It's been interesting. There have certainly been companies that have been widely spared from supply chain issues, which makes them all that much stronger if they are going out to market. But we've seen a lot of companies being forced to get a little bit more creative with their procurement. I think it's also highlighted for some companies certain areas of weaknesses and dependency from the vendor standpoints, from certain geographies. And it's helping some people kind of think differently about that. Can we bring on outside capital or outside business partners to help us think about a different process and maybe mitigate this for something in the future?
Got it. So I guess along those lines, we've introduced a couple concepts here that are kind of new. I mean, you Paige, since you were going there, have you felt the changes and the challenges that we've experienced, that you're experiencing now, they're obviously affecting the manner in which we do deals. Is this a negative, is it a positive development, or, is there a positive component that comes out of this?
Yeah, I mean, I think it really is reflected a lot in variability of earnings. One thing that, we've seen, certainly there's a lot of businesses that have been pushed up from the effects of COVID. They've had great demand, and that's really built on itself. That's something that we have to do a little bit of unraveling on. How much of that is pull forward demand? How much of that is sustainable and repeatable going forward? One thing that I think that's been a little bit interesting in the industry, even people who have seen downward pressure on earnings and sales coming out of COVID, have been more willing to sell than I think in the past, where normally you would have seen people sitting on their company waiting until performance came back up to be willing to do a transaction, and people are still bringing those to market. So sometimes that kind of creates an opportunity to be a little bit more creative in the deal structure and to still get something done. I think a lot of sellers, from their standpoint, for especially smaller business owners that we frequently interface with, they were mostly hands-off in their businesses. A lot of people had transitioned day to day to someone else, and COVID really hit these businesses hard and made some of those owners step back into a day-to-day role. And I think that it was a tiring year for a lot of business owners. So I think we've seen a little bit of deal flow where maybe you can be a bit more competitive because their performance isn't great right now, but they're still willing to get out.
I appreciate that. And I want to get to Matt and Kumi as well here, but maybe one thing that was mentioned there was variability of earnings, right? So, I'll turn it over to all the panelists here, but so as we move forward here, that's something that comes up in every transaction, whether it's sell side or buy side. If you're buy side, you're trying to peel back the layers of the onion and figure out what's the seller's true or revenue stream look like, what are their earnings look like. If you're on sell side, you're trying to look as attractive as possible. So what are some manners, or some metrics that you guys are looking at, to kind of, get through those variability issues?
I can take a stab. I'll take a stab at that. So I guess what we really look at, so for my business, is we really try and determine whatever the metrics are where we think we can better understand what is your real traction with your product. So a lot of that has to do with how are individuals using your product, how often are they coming back, what's the frequency that they're coming to use your product, and then really understanding how you're finding those users, just your distribution for that product. I think just on the variability piece specifically, I think that has impacted a lot of different industries in a lot of different ways. Home building, as an example, was one that we didn't know what was going to happen in March of 2020. And we actually thought it was going to be like the crisis of 2008. And then what actually happened was skyrocketing demand for homes. People decided they were ready to buy their first home, and you had all this pent up demand from millennials who basically have not been purchasing homes at the same rate as folks behind them that were now, because they were trapped at home, wanted a bigger space. And that industry saw a tremendous amount of growth. What we're seeing now is there's still that demand, but the supply chain problem has caught up to home builders. So the interesting thing is that dynamic of variability isn't even consistent intra-industry. So the home building market is actually experiencing a really interesting time right now, because there are people that have purchased homes that can't get them built because they can't get the supplies they need to build the homes. And it's just causing and that's just one specific industry. In auto insurance, what we saw at the beginning of COVID was profitability shot through the roof because people weren't driving. Now people are driving at a much higher frequency, and severity is up because the cost of used car vehicles has never been higher. So there's all of these factors that are going into that are impacting the predictability of businesses across many different industries.
I think it's a good call out, and it's, hey, what time frame are you looking at, and what is your time horizon, right? And if you look at just the trailing 12 months, I think anybody's P&L is going to be at least a little bit wonky, and so you got to be thinking about hey, what does that look like moving forward? What are the current pain points and disruptions, whether it's supply chain, people, labor shortage, otherwise. And how is that risk mitigated moving forward, or how does that change moving forward? And so, I think just touching on the labor market real quick, I think it's been pretty unique in that all ends of the spectrum have been impacted there, whether it's hourly workers or senior leadership. And I really do think recruiting and retention is a superpower. And it's only proven out more so to be the case during times like these where, you got to be pretty dynamic. Any leadership team, most have not seen an environment like this before, or at least some of the nuance associated with it. And so I think as a result, it really does come down to the people component in navigating, these interesting times. And, it is a differentiator among the best companies we've partnered with. And I don't think there's any silver bullets to, magically become a strong magnet for great people. But, that employee experience, isn't really reflected in a P&L, on a specific line item in a way that, is super easily identifiable and tracked and monitored. And so, I think COVID has flattened the world in many ways, with remote work becoming more pervasive. And, I think people are finding themselves not only competing on a, local level for talent, but, the world has flattened where you're kind of competing globally now, right? And I think it's great for companies in that it's opened up the labor pool in a way that maybe hasn't always been opened up to different groups. And, there's really great talent that's available. But I'd also argue on the employee side, it's even more important to drive that employee experience. And, it's great for the high performers. I think it's a little bit tougher for, the average or the low performers in that it used to be they were competing locally, right? And now, that the world's pretty flat, there's folks in other countries that can work digitally, that are more excited about that job and, willing to accept a certain payment level. And so I think it's going to be really interesting to see that ripple effect of, more comfort in the remote environment and how much the rubber band kind of snaps back to, what it was pre-COVID or, what it is now. So it'll be interesting.
Yeah, and I think to go off of Matt's point too, now more than ever, when we look and value companies, there are a lot of softer things that are becoming really critical. When you go in and you see a company that already has in place a wonderful culture, that's going to be a differentiator for them to attract and retain talent, which is such a big issue for many people. So I think that's something that, we look for very closely. What's the strength of the management team? Are they going to stay on? Do they have a lot of good, viable, existing up and coming people who might be able to step into larger roles down the line? What does their IT look like? Have they taken a step in the right direction to become a little bit more advanced? I think all of those things start to really play into your valuation when you do have a lot of variable earnings and there's a lot of things that you don't know about exactly how that's going to play out and what the timeline is going to look like for those companies. But certainly those that have a good team in place already, have a great culture, that drives a higher valuation.
That's a good point. And those talks, we're kind of talking about the old combinational synergies, right, that are now maybe seemingly more transformative nowadays. Matt, to piggyback on an idea you mentioned, when we talk about the employee experience, or we'll call it, management retention and stuff, what are some differentiators that we're, seeing in the market or that we're trying to, possibly indicate? You mentioned global competition is now a premium for talent. How do we acquire, or maybe more appropriately, how do we retain these talented individuals?
It's a good question. And, I really don't think there is a silver bullet, but I do think that, being adaptable is extremely important in kind of listening to, hey, what is that preferred work environment, while staying flexible. But I guess, I kind of liken it almost to, I spent a bunch of time, in the pet care space. I think it's going to continue to be really interesting over the next 5 to 10 years. And that, you're kind of seeing these waves that you've seen play out in like human healthcare, right? Around digital enablement, and this consumer 2.0 preferences. And I think the same applies to the employee side of the equation where, I think more and more folks have more and more options. And so, finding ways to differentiate and double down from and be a strong magnet, so to speak, I do think makes, a big difference. And I guess, you can't track anything that you don't monitor and have a metric around. And so, I do think as you think about, employee retention metrics, recruitment funnel and how you narrow the funnel, I do think it's very important how you think about those things, just given I've seen some pretty creative things done, whether it's through software, whether it's through, different roles in an organization that hits on the needle movers in pretty effective ways. And so, I think it's only going to become more and more important, and it is changing through the digital experience and adapting there. But I'd also say, through employee expectations and, kind of like consumer preferences are changing, that's directly applicable to, keeping folks within an organization as well. So.
Yeah, I think the expectations piece is really important. And what this meant, pre-COVID was, at least in technology, was you basically made your headquarters, your campus, like a fairyland, where you'd have gyms and you'd have great food and you'd have the dry cleaning and you'd have everything that would make people want to spend as much time there as possible. And what I think is going to be required going forward is how you think about that when people aren't coming into the same space every day, but you want them to be working just as many hours and just as committed to retaining at your business for long periods of time. And I think some of that that you're already seeing, at least some startups doing, are investing in kind of your own individual physical health and mental health, or home cleaning services as a benefit for people, and things that are actually just trying to improve each individual's lives in ways that work for the individual, that aren't centered on a headquarters and that aren't centered on a space and are more focused on the individual.
Yeah. And I think too, just thinking about how do you make those individual employees feel valued when they are maybe working from home, they're working in a more flexible setting, they're not going into the headquarters. How do you maintain that sense of connectivity to the bigger picture, the larger business, and not just their small individual team? I think that's something that a lot of people are looking for now, is how do they see a path forward in that company, and how tied in are they to the company's overall performance?
And I think, I'm probably a little bit more old school when it comes to, hey, it's great to see people in person and kind of interact that way. But, I think those that aren't adapting and are driving too hard of a line, I've seen remote work very effectively. It really depends on the company, the culture, and how it's managed. But, even through the investor lens and investor talent, I think we're going to see more and more groups more flexible to investment talent working remotely versus, strictly being in the office. And I think that opens up the pool of candidates in a very meaningful way. I think that's going to be an effective strategy to, open up that labor pool. You'll have to compete on, comp with where they're living, but I think that's something that's very doable for the right talent. But, for instance, I've met a few through an LP relationship, a few folks through Twitter, right? And, we've invested in a few things where, we've met digitally, we've brought it, in person, and we still interact digitally. But, I think it does open up the scope a little bit. And there's a lot of great companies in our backyard. I think Columbus and the Midwest has a crazy amount of opportunities, but, I would say that it's been fascinating to see, how meaningful of relationships you can facilitate if you do embrace digital in the right way. And it's, it opens up your field, and then, you can kind of, see more interesting things while also kind of competing locally too. So it's, it's a unique environment, and I think COVID has accelerated that, quite a bit.
So let me ask this, let me put it to the panel here. With that in mind, with the global competition here and kind of the decentralization of the employees, I mean, do you think that, moving forward in the next, 2 to 5 years or so, that there will be more of a premium placed on, traditional M&A activity, or with the free flow of employees, is there going to be, it's just going to be at-will employment, kind of pick and choosing? Is there going to be hyper-competitive employment process? Is there any thoughts around that?
Yeah, I think it's going to stay really competitive. I mean, we're also talking about a pool of people that can work remotely. We are heavy in the industrial space. There's a lot of a pool of labor that needs to be in the office, in the plant every single day. And I see that continuing to be more and more competitive. And I think as you get better talent options, you've got to be more competitive because people are looking at a variety of places. They're no longer just looking in Columbus or in Ohio. They can go almost anywhere they want. So for people who don't need to be in a certain place, I think we'll continue to get more competitive.
Well, this has been great. I want to go back to this, the Tiger Globals of the world, though, real quick here, because as time is kind of waning on us. We've talked about truncated due diligence, timing, pressures, integration, issues along with this. So as we have this, we have these new pools of capital, the velocity of capital has increased. It's hyper competitive now. From a timing perspective, how do you slow down the process? Assuming we're competing with somebody, that's just going to come in kind of sight unseen with a minimal amount of due diligence. How do we upfront evaluate, what a possible target, what their management team looks like, what possible synergies could be, on a severely truncated timeline?
So I have thoughts on this. I don't think you can slow down the process. I think what the Tiger effect essentially does is if you can't compete at that speed, you have to find other ways to compete. And to me, what I think will likely happen is that VC will actually go back to what VC was 20 years ago, which is smaller checks much earlier to get into deals, as opposed to what VC had kind of has evolved to, which is more of these much larger checks with companies that have already kind of have a traction with the product and they already have product market fit. I think if you are competing in that space, that world has changed so dramatically that unless you can write those same checks at the same velocity, you need to go earlier and take more risk pre-product market fit.
I think it's a good call. And one fine point, I'd say also, the relationship component, right? I think, that's a true differentiator and an edge early, and it allows you a little bit more flexibility. But, I'm a firm believer on the sourcing side that you got to get out, you got to shake the bushes, be curious, pull on threads, be a good connector among, extraordinary teams and businesses. And we see a lot of different opportunities, but, only invest in, a handful per year. And so I jokingly say, if we're not turning down good deals on a regular basis, we probably don't have good enough deal flow. And so, I think, tactically, though, it does come down to differentiation, and, the Tigers of the world are differentiating based on speed. If the entrepreneur or operating team knows they're going to get the check, it's going to be quick, not all that disruptive. And, to the point made earlier, I do think that, one of the questions was, hey, where's the deal market going in the next 5 to 10 years? And you've been seeing it more early stage, and I think it will happen later stage as well. But I think this power of the firm is slowly crumbling away, and it's really about, individual investors and brands that they've built, and, getting access to some of the best deals as a result. And so I think you might see more independent operators, or at least folks that have built strong personal brands that are almost agnostic of, and separate from the firm brand. And I see that kind of decentralizing in a pretty meaningful way. And you've seen it early stage, but I think it's going to happen more and more, later stage as well. And it'll just be interesting to see how it plays out. But
I think from the lower middle market perspective, I I kind of agree with Kumi that there is just an element of time you have to cultivate the relationship on both ends for the seller to get comfortable and for the buyer to get comfortable. I think that there are still a lot of sellers out there. They've put so much time and effort creating this business that they want to be thoughtful. They don't want to feel pressure that this has to be a very quick process. So I do think there's still a market out there for deals that won't move at quite that speed.
Yeah, and Chris, one point I'd add is, it's almost like, are you differentiating based on speed and certainty to close, or are you differentiating on branding, value add, and they think that you'll be a huge addition to the strategy moving forward, and so it ultimately investments are you're working with the partner there, not the firm, and so it goes back to, hey, what are you differentiating on, and you need one of those probably to effectively compete these days, but there's others too.
Excellent. Well, I hate to say it, but we're starting to run out of time here. So, Kumi, quick, 20 seconds. What's your bold prediction for M&A activity in 2022?
That's in 2022. I hope we bring a lot of great businesses here in Columbus. I think just more broadly, I think the time required that has historically been invested by entrepreneurs to raise capital, I think that time is just going to be cut. I think that's going to be much shorter, and that's not simply for the companies that are building world-changing businesses that Tiger's investing in. I think that is actually the impact of what's happening, is that it'll mean that entrepreneurs are spending less time having to raise capital and more time in trying to figure out how to grow their business.
Excellent. Well, I would love to get a few more perspectives, but unfortunately we're running out of time here. So again, I want to thank all the panelists for your time this morning. It's been very informative, and I'd like to encourage everybody here who's viewing, please attend the after session afterwards for a live Q&A, where you can lob questions over to our esteemed panelists. So once again, thank you to everybody, and greatly appreciate your time and effort and your insight.
Thank you.
Thanks, Chris.
Thanks.
Thank you, Chris, Kumi, Paige, and Matt. That was a great conversation. Ladies and gentlemen, if you don't know where you're going next, please visit the agenda tab, find a session that interests you, and add it to your My Agenda. We hope you have a great rest of the day.